Do you think the worst thing that can happen if you miss the 31st July income tax return deadline is a 5,000 rupees fine? Well, think again. For some taxpayers, filing even a day late could actually cost far more. You could lose the right to carry forward losses from your shares, mutual funds, or businesses, and that could increase your tax bill for years to come. For most salaried employees, pensioners, and taxpayers whose accounts don't require an audit, typically those filing ITR 1 or 2, 31st July 2026 is the deadline to file income tax returns for assessment year 26-27. There is one important exception, however. Non-audit business owners and professionals filing ITR 3 or 4 have been given an additional month. Their deadline is 31st August 2026. There has also been speculation that the government may extend the 31st July deadline because of glitches on the income tax portal, but as of now, no official extension has been announced. If you miss the deadline, you may have to pay a late filing fee under Section 234F. The maximum penalty is 5,000 rupees. But if your total income is up to 5 lakh rupees, the fee is capped at 1,000 rupees. And if you still have tax outstanding, interest under Section 234A will start at 1% per month or part of a month from 1st August until the tax is paid. But that's only the obvious cost. The bigger loss is something many taxpayers don't even realize until it's too late. Suppose you invested in shares or mutual funds this year and ended up making a loss. Now, normally the Income Tax Act allows you to carry forward that capital loss and use it to reduce tax on future capital gains for up to 8 assessment years. But there's one crucial condition. You must file your income tax return within the original due date. If you miss the deadline, that benefit is generally lost. So even if you later file a belated return, you cannot carry forward capital losses or most business losses. Here's a simple example. Imagine you sold shares this year and booked a 4 lakh rupees capital loss. A few years later, you earned a 6 lakh rupees capital gain. Had you filed your return on time, you could adjust the earlier loss against that gain and pay tax only on the remaining 2 lakh rupees subject to the applicable tax rules. But if you miss the filing deadline, you lose that adjustment. Your entire 6 lakh rupees gain could become taxable. That's why tax experts say the real cost of filing late isn't always the penalty. It's the tax benefit you may never recover. There's one important exception. Losses from house property can still be carried forward even if you file a belated return. But this exception does not apply to capital losses or most business losses. Even if you don't owe any tax, don't assume you can skip filing. Under the current tax regime, many taxpayers may end up with zero tax liability because of the available rebate. But if your income crosses the prescribed filing threshold, you're still required to file an income tax return. A zero tax bill does not automatically mean you're exempt from filing. So what happens if you actually miss the 31st July deadline? The good news is that you can still file a belated return until 31st December 2026. But it comes with its own trade-offs. You may have to pay a late filing fee, interest may apply if you have unpaid taxes, your tax refund, if any, could be delayed, and most importantly, you lose the right to carry forward eligible capital losses and most business losses. So if you've already filed your return on time but later discovered an error, you don't have to panic. You can file a revised return and the current deadline for doing so is 31st March 2027. So who should be specially careful about these changes? Well, this matters most if you invest in shares or mutual funds, sold a property at a loss, have business losses, expect a tax refund, or simply want to avoid penalties and compliance issues. For many salaried taxpayers whose employer has already deducted the correct amount of tax, the financial impact of filing late may be limited to a penalty and a delayed refund. But for investors and business owners, the consequences can extend well beyond this financial year.